I think as we look ahead into 2018, a lot of eyes will just be on the general economic conditions here in Canada and what level of uncertainty that might inject into the markets as we look at interest rates likely to rise. We're staring down a GDP decrease from 3% to 2% as we go into 2018. We've already seen two interest rate bumps, so it'll be interesting to see what impact the rising interest rates have into investor sentiment and how that factors into decisions that are made in the real estate industry. Many are saying that we're going to be facing economic headwinds just in general. So whenever you hear something like that, you get a little bit worried about how that slows down decision making and just finds its way into the key fundamentals of the real estate market. You know, we've had a really excellent ride of new development in the major gateway markets in Canada in 2017, and I think we'll see, a lot of continued upward momentum, certainly in Vancouver and Toronto and many of the gateway markets in 2018. And this presents a really interesting opportunity for both occupiers and investors. I think that we're going to see, occupiers get into the real estate decision cycle a lot earlier, having to get decision ready earlier and take space into their portfolios sooner because of upward pressure on rental rates. So that's an exciting opportunity for tenants in the market to take advantage of conditions. We're going to see a widening in the gap between CBD rates and suburban rates. So that's an exciting growth story for the suburban markets where tenants will really start taking a harder look at the suburbs. So I think we'll see that growth to continue. And for investors, well, it'll be a pretty exciting time to think of alternative ways to deploy capital and reposition buildings as tenants continue to push a flight to quality.